Stop. If you're staring at the silver price on your screen, you're already behind. The number doesn't matter. What matters is that the ceiling just came off, and almost nobody noticed. Everything you think you understand about silver, JP Morgan, and price suppression is about to flip. Because the biggest mistake you can make right now is believing this is just another rally, another spike, another fake out that will be sold back down the way it always has been. That belief is exactly what keeps people late. You're being trained to watch the wrong thing. The price is the distraction. The chart is the decoy. The commentary is noise designed to keep you anchored to a framework that no longer applies. Silver didn't break out. It wasn't allowed to run. And this is not momentum traders finally getting rewarded. What just happened is structural. And structural changes do not announce themselves with headlines or alarms. They move quietly underneath the surface while everyone else argues about candles and resistance levels. Right now, most people are still debating whether this move is real. They're asking if it will hold. They're waiting for confirmation. That alone tells you they've already missed the shift. Because confirmation only exists inside the old system. And the old system is what just failed. For years, decades really, silver traded inside an invisible box. Every rally stalled at the same zones. Every surge was met with sudden selling that made no economic sense. And the explanation was always the same: manipulation, suppression, paper shorts. That explanation trained an entire generation to expect one outcome: a violent upside explosion caused by shorts being forced to cover. But that expectation is now a liability. Because what just changed is not sentiment, it's control. You don't remove a ceiling by accident. You don't let a market reprice after 15 years of containment unless the incentive structure has flipped. And incentives only flip when ownership has already changed hands. Look at what didn't happen. There was no emergency meeting, no regulatory intervention, no sudden surge in mine supply, no miraculous technological breakthrough that replaced silver's industrial role. Nothing new occurred on the surface, which tells you the change didn't happen today. It happened years ago, and today is simply when the restraint was released. This is the part most people struggle to grasp. Markets don't move when information becomes available. They move when positioning is complete. The accumulation phase is silent, the distribution phase is loud, and silence is exactly what defined silver for the last decade and a half. While attention was on equities, crypto, housing, and AI, silver sat in the corner. Boring, frustrating, range-bound. That wasn't neglect, that was design. Because the most valuable assets are accumulated when nobody wants them and nobody is watching. The moment you see excitement, the game is already in its next phase. Ask yourself a simple question. If silver suppression was truly an open and shut crime that endangered the entire banking system, why was it tolerated for so long? Why were fines trivial? Why were investigations endless and inconclusive? Why did nothing ever actually change? Because suppression wasn't the end game, it was the mechanism. And mechanisms only persist when they benefit power. What you're seeing now is not silver escaping. It's silver being repositioned. There is a difference. Escapes are chaotic. Repositioning is controlled, and control is the one constant you should never underestimate. This is why focusing on the price will get you blindsided. Price tells you what the crowd thinks. Structure tells you what institutions have already done. Right now, structure is screaming. The physical market is tight in ways paper traders cannot model. Industrial demand is no longer cyclical. It's locked in by long-term infrastructure commitments. Geopolitics is no longer neutral toward metals. It's strategic. And yet, the narrative most people are still operating under is from 2011. They're waiting for a squeeze. They're waiting for justice. They're waiting for validation. None of that is coming. Because what's happening now doesn't need your belief. It only needs your absence. When a ceiling is removed, you don't hear it. You feel it later, when access disappears, when premiums explode, when delivery timelines stretch, when contracts quietly change language. By the time price confirms the move, the repricing is already irreversible. That's why this moment matters. Not because silver is up, but because the behavior around silver has changed. The sellers aren't showing up the way they used to. The pushback isn't there. The familiar hand pressing the market back into its cage has stepped aside, and powerful hands only step aside when they're standing somewhere else, higher up the food chain. Most people will miss this entirely because they're waiting for proof. They want a headline. They want a number that feels undeniable. But markets don't reward people who wait to be convinced. They reward people who recognize when the rules stop applying. Right now, the old rule, that silver cannot be allowed to run, is gone. And once a rule disappears, it never comes back. The people still arguing about whether this is real are about to discover that reality doesn't ask for consensus. It just moves. And if you're still watching the price, trying to decide what you believe, you're already reacting, not positioning. Because the ceiling didn't come off for you. It came off because it was no longer needed. And what replaces a ceiling is never benign. For years, we believed a very specific story. We believed JP Morgan was the villain. We believed they were trapped in a massive naked short position. We believed silver was being crushed illegally, held down by paper contracts that could never be delivered, and that one day the pressure would snap, forcing a historic short squeeze that would expose the entire system. That belief didn't come from nowhere. It was reinforced, repeated, validated, fed back to the public for more than a decade. Every stalled rally proved it. Every sudden sell-off confirmed it. Every CFTC investigation that went nowhere hardened it. And that's exactly why it worked. Because the most effective narratives are the ones that feel true, look true, and explain real pain, while still pointing in the wrong direction. We weren't a little wrong. We were completely backwards. This isn't happening because shorts are being forced to cover. That's the decoy. The real mechanism was never a trapped position. It was a time-release strategy. Here's the mental trap almost everyone fell into. They assumed that because silver prices were suppressed, the suppressor must be losing. That assumption is emotionally satisfying, but structurally naive. Markets are not moral systems. They are control systems. And control does not come from being right in public. It comes from owning supply in private. If JP Morgan were truly trapped in an existential short, the last thing you would see is 15 years of calm continuity. You would see volatility. You would see desperation. You would see disorder. Instead, what you saw was discipline. Year after year, silver was capped with almost mechanical precision. Rallies were allowed just far enough to entice participation, then smothered. Speculators were punished repeatedly until only the most stubborn remained. That is not the behavior of a cornered player. That is the behavior of a patient accumulator. The mainstream belief told you JP Morgan was bleeding. The price action told a different story. They were in control. Ask yourself something uncomfortable. If the banking system was truly at risk of a catastrophic silver squeeze, why would regulators allow it to persist for over a decade? Why would position limits remain flexible? Why would penalties be minor and retrospective? Because nothing was broken from the perspective that mattered. The paper market wasn't a flaw. It was the tool. By keeping the price low, volatility contained, and narratives focused on eventual justice, the physical market could be drained quietly, without competition, without panic, without attention. The public thought suppression meant weakness. In reality, suppression meant leverage. This is where the reversal becomes clear. For 15 years, retail investors believed they were early rebels, stacking against the system, waiting for the moment the dam broke. In reality, they were unknowingly cooperating with the largest physical accumulation in history, not because they were manipulated individually, but because the story they believed kept them passive. It told them to wait, to hold, to expect a sudden, dramatic payoff that would expose villains and reward patience. That story kept silver cheap. That story kept demand steady but non-threatening. That story kept pressure off the physical market. And all the while, ownership was changing. This is not how short squeezes work. Short squeezes are reactive. They are violent. They force immediate behavior changes. And what we are seeing now is deliberate, measured, aligned. The old belief says they lost control, so price is running. The new reality is simpler and more unsettling. Control was never lost. It was relocated. When an institution truly loses control of a market, it fights, it intervenes, it escalates suppression. What you're seeing instead is withdrawal. The selling pressure that used to appear out of nowhere is fading. The ceiling that once felt immovable is no longer defended. That does not happen when someone is trapped. It happens when someone is finished. Finished accumulating, finished engineering the environment, finished needing the price to stay low. This is the moment where most people cling hardest to the old belief, because abandoning it means admitting they misunderstood the entire game. It means accepting that the villain narrative was incomplete, that the enemy was not panicking but planning, that the outcome will not be a sudden liberation, but a managed repricing that benefits the holder of supply, not the holder of paper. This reframes everything. If JP Morgan is no longer net short, then higher prices are not a threat. They are an asset. If the physical stockpile is already secured, then volatility works in their favor. If industrial users are structurally dependent on silver, then scarcity becomes pricing power. In that framework, the old story collapses. There is no need for a dramatic squeeze. There is no need for public capitulation. There is no need for justice or exposure. All that is required is time and tightening availability. That's why this move feels strange to people who have followed silver for years. It doesn't feel explosive. It doesn't feel chaotic. It feels allowed. And allowed is the most dangerous word in markets, because nothing is allowed unless it serves someone's interest. This is why the belief reversal matters more than any chart pattern. If you still believe this is a short squeeze, you will expect resolution. You will expect an end. You will expect prices to overshoot and collapse back into a familiar range. But if this is a controlled repricing, there is no natural return point. The floor rises. The reference price resets. And the people waiting for a crash never get one. That's the psychological damage of the old narrative. It trains people to wait for the wrong signal. They're watching for panic in banks. They're watching for margin calls. They're watching for headlines about failed delivery. Meanwhile, the real signal is absence. Absence of supply. Absence of resistance. Absence of the old suppression behavior. Those absences tell you the story has already changed, even if the headlines haven't caught up. The dominant belief said, one day they'll be forced to give up. The new reality is colder. They already did, because they no longer need the same outcome. And once you understand that, the rally stops looking like a victory for the public, and starts looking like the opening phase of something much more controlled, much more asymmetrical, and much more difficult to escape. This isn't the system breaking. This is the system finishing one phase and quietly entering the next. Here's what actually changed. Not today, not this week, not even this year. What changed is that the accumulation phase ended, and the consequences of that ending are now propagating through a system that was never designed to handle physical scarcity. This is the part people miss because they're trained to look for events instead of completion. Markets don't pivot when a headline drops. They pivot when positioning is finished, and the positioning in silver was finished a long time ago. Let's anchor this properly. In March 2008, Bear Stearns collapsed. That wasn't just an investment bank failure. It was a transfer of risk, exposure, and inventory. When JP Morgan absorbed Bear Stearns, it didn't just inherit paper contracts. It inherited physical silver positions, warehouse relationships, delivery obligations, and the institutional map of how the silver market actually functioned behind the scenes. That moment matters because it marks the beginning of a time-based strategy, not a trade. From that point forward, the behavior becomes consistent, almost boring in its precision. Silver prices remain suppressed relative to monetary expansion. Volatility is contained. Every rally is capped before it can trigger reflexive industrial hoarding. And quietly, relentlessly, physical metal is removed from the market, not in one dramatic move, in increments. Through COMEX withdrawals, ETF inventory control, OTC transactions, and bilateral deals that never show up on a retail screen. Over 15 to 17 years, that adds up. The numbers people whisper about, 700 million, 750 million ounces, sound absurd until you do the math. Global mine supply averages roughly 800 to 850 million ounces per year. Industrial consumption alone absorbs the majority of that. The excess available for investment and strategic accumulation is far smaller than most assume. You don't need to buy everything. You only need to buy what's left. And that's what happened. This wasn't hoarding in the open market. It was strategic absorption during moments of forced selling. When miners hedged, when funds liquidated, when retail capitulated after yet another failed breakout. Every cycle trained participants to do the same thing. Sell rallies, abandon hope, move on. That behavioral conditioning is just as important as the metal itself, because while people were emotionally exiting, inventory was quietly consolidating. This is where institutional language matters. JP Morgan didn't bet on silver. They structured exposure. They didn't speculate on price. They secured optionality. Owning physical silver at suppressed prices gives you something no derivative ever can: time-independent leverage. You can wait, you can ration, you can withhold. Paper traders must act. Physical holders choose. That distinction is now becoming visible. The data people aren't talking about is not found in RSI or moving averages. It's in delivery ratios, lease rates, warehouse classifications, and the growing divergence between paper volume and physical availability. When registered inventories shrink while open interest remains elevated, that's not bullish sentiment, that's structural strain. When premiums rise, even as spot prices lag, that's not retail mania, that's supply friction. When industrial buyers begin securing long-term contracts instead of spot purchases, that's not speculation, that's risk management. These are not late cycle signals, they are transition signals, and transitions don't reverse. Another critical detail, JP Morgan's behavior has shifted from defensive to passive. In the past, price spikes were met with immediate force, massive sell orders appearing in illiquid hours, designed not to optimize execution but to cap momentum. That behavior has changed. The absence of aggression is the signal. Institutions do not stop defending levels unless defending them no longer serves a purpose. And the purpose was never ideological. It was logistical. Low prices kept silver flowing. Low prices prevented industrial panic. Low prices discouraged substitution research and strategic stockpiling. But once the physical stockpile is secure, those incentives flip. Higher prices no longer threaten access. They enhance control. At that point, the optimal strategy is no longer suppression. It's patience. Let the market discover scarcity slowly. Let industry adjust too late. Let price do the rationing. But this is why time anchoring matters. Right now, today, silver is no longer behaving like a speculative asset. It's behaving like a constrained input. And constrained inputs don't crash. They gap. The calm tone of this transition is misleading people. They're expecting fireworks because they've been promised fireworks for years. Instead, what they're getting is inevitability. The reason you haven't seen panic yet is because panic requires surprise, and institutions move to eliminate surprise for themselves. Industry hasn't panicked because contracts are still being honored. Deliveries are still occurring. The illusion of abundance remains intact, but illusions don't need to collapse violently to end. They just need to stop being refreshed. And that's what's happening now. No new supply is coming online fast enough. No recycling surge can bridge the gap. No paper innovation can create atoms of silver. Geology doesn't negotiate. Physics doesn't care about sentiment. When the flow tightens enough, price becomes the only variable left. This is why the old framework, manipulation versus free market, no longer explains what you're seeing. Manipulation implies constant effort. What you're seeing now is release. Release happens after effort is complete. Think about the asymmetry. If you control hundreds of millions of ounces of physical silver, every marginal buyer works for you. Every shortage benefits you. Every delay strengthens your position. You don't need to predict demand precisely. You only need to know it cannot be easily reduced. And silver demand cannot be reduced without breaking modern infrastructure. That's the institutional calculus. This is also why the tone has shifted subtly across markets. Silver is no longer mocked as a barbarous relic or fringe investment. It's increasingly framed as an industrial necessity with monetary characteristics. That framing didn't emerge organically. It emerged when it became useful. Here's the key realization that locks this section into place. If JP Morgan were wrong, truly wrong to talk about silver, this entire strategy would have been suicidal, tying up capital, absorbing inventory, maintaining suppression for over a decade. No institution commits to that scale without conviction rooted in supply-side reality. They weren't guessing. They understood something early that the market is only now being forced to confront. Silver is scarce in practice, not just in theory, and once that understanding becomes common, the repricing cannot be undone. So when you ask, what changed? The answer is not price. The answer is completion. Accumulation is finished, control is secured, and the system is now being allowed to reprice, slowly enough to avoid chaos, but fast enough to reset expectations. That's why this moment feels oddly quiet for something so significant. The loud part comes later. What you're seeing now is the calm acknowledgement phase, where institutions reposition language, exposure, and risk models ahead of a reality they already understand. The rest of the market is just being invited to catch up. Whether it does in time is not the system's concern anymore. This wasn't a mistake. It was designed. That sentence is uncomfortable because it strips away the idea that anyone is coming to save the public from what happened. It reframes 15 years of frustration not as incompetence or corruption spiraling out of control, but as something far colder, alignment. Because if this were a mistake, it would have corrected itself. If it were reckless, it would have blown up. If it were truly illegal at a systemic level, it would have been stopped. None of those things happened. Instead, the same pattern repeated with mechanical consistency for over a decade. And systems do not repeat what doesn't work for the people running them. While everyone else believed one story, someone else was positioning quietly. The public narrative said silver was broken. The institutional behavior said silver was being prepared. That gap between what people believed and what was actually happening is the betrayal. The villain in this story was never just a bank. It was opacity itself, an opaque system where power operates without needing public approval, where outcomes are shaped long before explanations are offered, and where the loudest arguments are often the least relevant. For years, the visible enemy was the bullion banks. Charts were annotated, positions were tracked, outrage was focused. But outrage is not a threat to power. Attention is not resistance. And while the public was emotionally invested in being right about manipulation, the actual transfer of advantage was already underway. The real victims weren't traders arguing online. They were industries and governments operating under a false assumption of abundance. Manufacturers built supply chains assuming silver would always be available at predictable prices. Defense planners assumed inputs could be sourced on demand. Energy policy assumed materials would follow ideology. Those assumptions are now becoming liabilities, because this wasn't a mistake in forecasting. It was a long-running misdirection. The public wasn't wrong to sense something was off. They were wrong about where the leverage was. They thought the system was fragile. It wasn't. They thought suppression meant desperation. It meant patience. This is where the moral inversion occurs, and why it's so difficult for people to accept. Retail silver holders who believed they were resisting the system were in fact stabilizing it, not intentionally, not knowingly, but functionally. By absorbing small amounts of physical metal consistently, without triggering panic, without demanding delivery at scale, without forcing industrial users to react, they helped keep the transition smooth. They were not the threat. They were the buffer. Meanwhile, the real power was consolidating where it always does, in ownership, not argument. This is why the phrase price suppression was so effective. It gave people something to fight, a villain that felt obvious, visible, and defeatable. What it hid was far more dangerous. That suppression was not the objective, but the camouflage. Because you don't suppress something you don't want. You suppress what you're trying to acquire cheaply and quietly. And that creates the central betrayal of this entire period. The public believed they were being robbed in plain sight, when in reality they were being lulled into inaction while the ground shifted beneath them. The betrayal wasn't that silver was held down. The betrayal was that people were encouraged to believe that holding down the price was the end of the story. It wasn't. The end game was control, not over price, but over flow. Once you control flow, price becomes a tool instead of a risk. This is where the villain-victim frame sharpens. The villain is not a single institution acting alone. It is a system that rewards foresight and punishes visibility. The victim is not the traitor who missed a breakout. It is the late participant who still believes the rules apply evenly. And the betrayal is temporal. The damage doesn't occur when the system is built. It occurs when the system changes phase and the public realizes they were preparing for the wrong outcome. For years, the emotional payoff promised to silver holders was vindication. A moment where the truth would come out, a moment where the manipulators would be exposed and punished. That moment is not coming, because exposure is unnecessary when ownership has already shifted. The system does not need to apologize when it wins quietly. This is why the current transition feels so disorienting. People expected the villain to panic. Instead, the villain stepped aside. They expected a fight. Instead, they're seeing absence, and absence is far more threatening than confrontation. When supply dries up without drama, there is no enemy to blame, only consequences to manage. That's when the victim realization hits. Industrial buyers will discover that contracts do not guarantee material. Governments will discover that strategic stockpiles are thinner than models assumed. Markets will discover that paper volume does not equal physical access. And retail participants will discover that the narrative they emotionally invested in no longer explains outcomes. This is where anger turns into loyalty, not toward a cause, but toward a lens. Once someone accepts that the system was never going to break the way they imagined, they either disengage completely or they double down on understanding power as it actually operates. That's the lock-in. Because shared enemies create tribes, but shared realization creates alignment. The realization is this: no one is coming to restore fairness. No one is going to rewind the accumulation phase. No one is obligated to make the transition comfortable. This wasn't theft in the dramatic sense. It was acquisition under cover of narrative. And narratives are the cheapest currency there is. The public was given one narrative to argue over, while another narrative, the real one, played out in balance sheets, vaults, and long-term positioning. That is the betrayal. Not that silver was suppressed, but that people were encouraged to believe suppression was the whole crime. In reality, suppression was just the first chapter. Now comes the chapter where scarcity is monetized, not hidden. And this is where moral framing becomes unavoidable. Because when industry is forced to pay any price to secure input, when governments prioritize access over cost, when inflation is quietly transmitted through supply constraints rather than monetary policy, the consequences land downstream on consumers, on workers, on anyone without ownership. The villain will not be visible at that stage. They will simply be positioned. And the victims will not be angry at first. They will be confused. Confusion delays resistance. Confusion buys time. This is why the transition is happening slowly enough to avoid shock, but decisively enough to be irreversible. No single event to protest. No single announcement to react to. Just a gradual tightening that feels like the way things are now. That is how power prefers to move. By the time people realize they're on the wrong side of the transfer is already complete. And the most unsettling part of all is this: the public didn't lose because they were foolish. They lost because they believed the system would fail loudly. It didn't. It succeeded quietly. And now the same people who once thought they were fighting the system are about to discover they were simply early participants in a much larger reallocation of value, one that does not require their understanding, approval, or agreement to continue. That is the true villain-victim frame. Not good versus evil, but prepared versus unprepared. And in that framing, the line has already been drawn. This is where it gets dangerous. Not dramatic, not explosive. Dangerous in the quiet, systemic way that only shows up after there's no way to reverse it. Because scarcity does not announce itself with a crash. It announces itself with friction. Small delays, minor exceptions, language changes buried in contracts. Premiums that refuse to come back down even when price pulls back. That's how scarcity enters a system that was built on the assumption of abundance. And silver has crossed that line. For decades, silver was treated as a flexible input. If demand rose, supply would respond. If price spiked, substitution or thrifting would kick in. If inventories tightened, paper markets would smooth it out. That model no longer works, not because demand surged overnight, but because demand stopped being optional. Silver is now embedded in systems that cannot scale down without breaking something critical. Electric vehicles are not a trend. They are policy-backed infrastructure. Solar is not a cyclical industry. It is a mandated energy transition. Defense electronics are not discretionary. They are geopolitical insurance. Each of these sectors requires silver not as a luxury, but as a functional necessity. And here's the part most people still haven't internalized. Industrial demand for silver is no longer price sensitive in the way it used to be. When silver was primarily a photographic or decorative metal, price elasticity mattered. Now it's a bottleneck material. If silver doubles, solar manufacturers don't stop producing panels. They absorb the cost or pass it downstream. If silver triples, defense contracts don't get canceled. They get repriced. This is what systemic demand looks like. It does not retreat. It competes. And competition for a constrained input does not resolve through markets. It resolves through prioritization. That's where things start to fracture, because markets assume equal access. Systems do not. Right now, silver is still flowing, barely enough to preserve the illusion of normality, but the flow is tightening in ways that don't show up on a chart. Long-term supply contracts are being locked in quietly. Industrial buyers are extending delivery timelines, not because they want flexibility, but because flexibility is disappearing. Inventory buffers are shrinking, not expanding. These are not defensive moves by speculators. They are survival moves by manufacturers. This is why scarcity becomes systemic before it becomes obvious. By the time the price reflects it cleanly, the real decisions have already been made. Now add the geopolitical layer. China is not just a participant in the silver market. It is a central processor, refiner, and manufacturer across multiple silver-intensive supply chains. When policy alignment shifts toward resource security, exports stop being commercial decisions and start being strategic ones. Beginning January 2026, the expectation is not that China will ban silver exports in a dramatic way. That's not how this works. The restriction will come through licensing, through prioritization, through temporary domestic allocation measures tied to national objectives. On paper, silver will still be tradable. In practice, it will no longer be freely available. That distinction matters more than any headline, because once a major node in the global supply chain redirects flow inward, the rest of the system doesn't adapt smoothly. It competes. European manufacturers scramble. U.S. defense suppliers reprioritize. Emerging markets get pushed to the back of the line. Price becomes secondary to access. This is the phase nobody survives cleanly. Not because silver disappears, but because the assumption of equal availability collapses. And when that assumption collapses, paper mechanisms fail first. Futures contracts assume deliverability. ETFs assume liquidity. Hedging strategies assume replacement supply. Those assumptions break quietly, one exception at a time. Force majeure clauses get invoked. Delivery windows stretch. Cash settlement becomes temporary. This isn't chaos. It's controlled degradation. And controlled degradation always favors whoever controls the physical. This is why the escalation doesn't resolve. Every new constraint compounds the next one. When China restricts exports, Western buyers lean harder on existing suppliers. When those suppliers can't scale fast enough, inventories drain. When inventories drain, premiums rise independently of spot price. When premiums rise, paper pricing loses relevance. Each step narrows the system's margin for error. And at no point does anyone step in to fix it, because from a power perspective, nothing is broken. Scarcity reallocates leverage upward. That's the design feature. This is also where timing becomes lethal. Most people think they'll have time to react once it's obvious. They won't. Because by the time scarcity is obvious, options have already closed. Manufacturers won't be bidding against each other on an open market. They'll be negotiating privately for guaranteed allocation. Governments won't be debating policy. They'll be invoking national security exemptions. Retail participants won't be choosing between buying or selling. They'll be discovering which vehicles actually have metal behind them. This is why the escalation feels slow until it doesn't. Systems fail gradually, then suddenly. But the suddenly only applies to people who weren't watching structure. From a structural perspective, this has been telegraphed for years. Mine supply is stagnant. Grades are declining. New projects are capital intensive and slow. Recycling is capped by end-of-life cycles. There is no surge capacity. Silver cannot be summoned by price alone. That's the fatal flaw in the old model, the belief that markets can always equilibrate. They can't when geology, physics, and geopolitics align. And that alignment is now tightening. This is where it gets worse. As scarcity deepens, price stops being the rationing mechanism and starts being the justification. Higher prices will be used to explain shortages, not solve them. It's expensive. That's why it's scarce. That inversion allows institutions to avoid admitting the real problem. There isn't enough flow to satisfy all claims, so claims will be sorted. And sorting claims is never neutral. Defense before consumer, domestic before foreign, strategic before discretionary. That hierarchy is already forming. You just don't see it yet because it's happening inside procurement departments, not trading desks. By the time it reaches markets, the outcome is already locked in. This is why escalation never concludes. Every solution creates a new constraint. Every adaptation tightens another bottleneck. And at no point does the system return to equilibrium, because equilibrium assumes reversibility. Scarcity is not reversible on human timelines. Once industry is forced to redesign around constrained silver, those changes are permanent. Once governments treat silver as strategic, access becomes political. Once pricing power shifts to holders of physical, paper claims become conditional. This is not a crisis you trade. It's a transition you survive or don't. And the most dangerous part is that nothing has broken yet. Lights are still on, products are still shipping, contracts are still being honored, which means most people will continue to assume there's time. There isn't. Because when systems reach this stage, they don't fail loudly, they narrow. And once a system narrows enough, only those already inside the priority lane continue moving. Everyone else discovers, too late, that the road didn't end. It just stopped being available to them. This is the phase nobody escapes cleanly, and it's only just beginning. But this isn't the real problem. The real problem is not scarcity by itself. Markets have dealt with shortages before. Prices rise, supply responds, equilibrium returns. That playbook assumes one thing that is no longer true. It assumes the dominant holder of supply wants equilibrium. That assumption just broke. What you're watching right now is not a market losing control. It's a market discovering who already has it. For years, the silver market behaved as if there were an invisible hand pressing down on price. Every time momentum built, it vanished. Every time confidence returned, it was punished. That hand is no longer there. And hands like that do not disappear unless they are no longer needed. This is the part people underestimate because they're trained to think in terms of intent at the moment, not intent over time. JP Morgan didn't wake up one day and change its mind about silver. It completed a phase. Suppressing price is expensive. It requires constant intervention, constant exposure, constant reputational risk. You only do that when the benefit outweighs the cost. Once the benefit is secured, the optimal move is not to keep fighting the market. It's to step aside and let the market work for you. That's what removing a ceiling actually means. It doesn't mean silver is suddenly free. It means price is now a tool instead of a threat. And that distinction changes everything downstream. When a dominant physical holder defends low prices, it's because low prices serve accumulation. When that defense ends, it's because accumulation is complete. From that point forward, higher prices are no longer dangerous. They are useful. Higher prices justify rationing. Higher prices normalize shortages. Higher prices transfer blame away from allocation decisions and onto the market. This is how power exits quietly. There is no announcement that suppression has ended. There is no press release declaring a new regime. There is simply absence. Absence of resistance. Absence of forced sell-offs. Absence of the familiar behavior that trained traders for 15 years. And absence is the loudest signal institutions ever give. Watch what is no longer happening. Silver rallies are no longer met with immediate, violent paper selling. Illiquid hour smashes are rarer. Momentum is no longer suffocated at predictable levels. This does not mean manipulation stopped because regulators finally intervened. It means manipulation is no longer pointed in that direction. Control doesn't vanish. It reorients. If you own the physical, you do not need to cap price. You let price rise just enough to do the work for you. Price becomes the rationing mechanism. Volatility becomes the intimidation mechanism. Uncertainty becomes the filter. Weak hands exit. Late buyers hesitate. Industrial users panic privately while appearing calm publicly. All of this benefits the holder of supply. This is why the current move feels strangely orderly. People expected chaos when suppression ended. Instead, they're seeing a grind. That grind is intentional. A vertical move would trigger political attention, emergency policy, and substitution efforts. A controlled ascent resets expectations without triggering intervention. It's not about maximizing price today. It's about maximizing leverage tomorrow. This is the part that turns silver from a trade into a strategic instrument. Once prices rise enough to justify strategic inventory management, withholding supply becomes rational, not suspicious. Warehouses don't empty, they become selective. Delivery doesn't stop, it becomes conditional. This is where the asymmetry becomes brutal. Paper holders are exposed to volatility. Physical holders are insulated by time. If price spikes, paper longs face margin. Physical holders face opportunity. If price dips, paper holders panic. Physical holders wait. The removal of the ceiling does not create freedom. It creates hierarchy. And hierarchy is exactly what industrial panic reveals. Because when manufacturers realize silver cannot be sourced reliably, they don't bid on exchanges. They pick up phones. They negotiate priority. They secure allocation. They accept higher prices for certainty. And certainty is the one thing paper markets cannot deliver. This is why the real profit is not made in the first leg up. The real profit is made in the spread between those who must buy and those who can choose when to sell. That spread widens dramatically when supply is withheld deliberately, not hoarded forever, just delayed. Delayed enough to force urgency, delayed enough to reset contracts, delayed enough to normalize higher reference prices. This is controlled repricing, not a squeeze, not a liberation, a recalibration of who has leverage. And here's the uncomfortable implication most people haven't processed yet. If the ceiling has been removed, it means someone is comfortable with what comes next. Institutions do not relinquish control unless the next phase is already mapped. That map includes industrial users absorbing higher costs, governments tolerating higher prices under the banner of security, inflation being blamed on supply constraints rather than policy, physical holders dictating terms quietly. This is not accidental alignment. It's strategic, and it explains why there's no attempt to save downstream users, no emergency releases, no coordinated messaging to calm markets, because calm is no longer the priority. Predictability is predictable scarcity, predictable tightening, predictable upward pressure that becomes background reality instead of shock. Once silver is accepted as structurally scarce, the argument ends. People stop asking, why is this happening? They start asking, how do we adapt? And adaptation always favors whoever is already positioned. This is why the removal of the ceiling is the real inflection point, and not the price level. Price can retrace. Price can consolidate. Ceilings, once removed, do not get reinstalled, because reinstalling a ceiling would require resuming suppression, and suppression would now work against the holder of supply. At this stage, defending low prices would be irrational. It would undermine leverage. It would delay monetization. It would preserve a system that no longer serves the dominant position. So instead, the system is allowed to strain, not break, strain, enough to extract value, enough to force compliance, enough to reorder priorities. This is why waiting for the top misses the point. There is no top in a controlled repricing, only stages. Each stage resets what feels expensive. Each stage trains participants to accept a new normal. By the time people say silver is too high, they will already depend on it at that level. That dependency is the end game, because dependency removes choice, and when choice disappears, pricing power becomes absolute. This is the phase most people misunderstand because it doesn't feel hostile. It feels inevitable. And inevitability is the most powerful weapon markets have, not because it scares people, but because it exhausts them. They stop resisting, they stop expecting relief, they start planning around constraints. That's when the ceiling's removal does its real work. Not by launching silver into the stratosphere overnight, but by quietly locking in a future where access, not price, is the deciding factor. And once access is the deciding factor, the question is no longer how high can silver go. The question becomes who gets it at all. That question has already been answered. The market just hasn't realized it yet. And the moment this crosses the threshold, the system reacts. Not with sirens, not with headlines, not with a dramatic collapse that gives everyone the same information at the same time. It reacts the way all mature systems react, when pressure becomes unavoidable. Quietly, selectively, and in ways that are only obvious after the door is already closed. This is where most people get wiped out. Not because they were reckless, but because they were waiting for a signal that was never coming. For years, people were trained to believe that the end would be loud, that failure would be spectacular, that when silver finally broke, everyone would know at once. That belief is the final trap, because systems like this do not end with explosions. They end with protocol changes. The first reaction is not price, it's language. Contract terms shift, delivery clauses become more flexible. Best effort replaces guaranteed. Cash settlement becomes normalized, not exceptional. Nothing appears broken. Everything still functions, just not the way it used to. This is how a system defends itself without admitting stress. What happens next is not theoretical anymore. You start to see divergence. Spot price says one thing. Physical availability says another. Premiums detach and never quite return to baseline. Delivery timelines stretch from weeks to months. Certain forms of silver become hard to source, then temporarily unavailable, then quietly repriced out of reach. At first, this is dismissed as logistics, then as temporary disruption, then as the new normal. And this is the point of no return, because once participants adapt to a constrained reality, the old reality no longer exists. This is where people finally realize that paper exposure and physical control are not the same thing. Paper promises liquidity. Physical ownership dictates terms. That distinction doesn't matter when supply is abundant. It matters immensely when supply is rationed. This is when the hierarchy becomes visible. Some buyers get filled, some don't. Some industries receive priority. Some are forced to redesign products, delay projects, or absorb costs they never planned for. Some governments treat silver as strategic. Others discover too late that they assumed access instead of securing it. No announcement is made. No apology is offered. The system simply reallocates. This is the transfer phase. Not a transfer of money in the obvious sense, but a transfer of leverage. Leverage moves away from those who assumed continuity and toward those who planned for constraint. And once leverage moves, it does not come back. This is why waiting for a top misses the entire point. In a controlled repricing, there is no emotional climax. There is only exhaustion. Exhaustion from adapting. Exhaustion from higher costs. Exhaustion from uncertainty that never quite resolves. People don't capitulate in one moment. They surrender gradually. They stop asking when things will go back to normal. They start budgeting for the abnormal. That is the real reset. By the time the average participant feels confident again, confident that silver is stable at a much higher level, the repricing is already embedded in every downstream cost structure. At that point, reversal is not just unlikely. It's undesirable for those in control. Why would a system voluntarily return leverage to buyers once it has shifted to sellers? Why would holders of physical willingly recreate abundance after scarcity has proven so profitable? They wouldn't, and they won't. This is why the ending of this story does not look like justice or vindication. There is no moment where someone rings a bell and declares the truth revealed. The ending looks like acceptance. Acceptance that silver is expensive. Acceptance that access matters more than price. Acceptance that some markets are no longer free in the way people were taught to expect. This is why most people lose without ever making a bad trade. They simply wake up one day in a world where the assumptions they relied on no longer hold, and by then, adapting is far more costly than positioning would have been. And this is the quiet cruelty of systems like this. They don't punish ignorance immediately. They punish delay. The people who get hurt are not the ones who disagreed. They're the ones who waited for certainty. Certainty never arrives in advance. It only appears in hindsight. By the time something is undeniable, it is no longer actionable. That's the final asymmetry. Those who understand early are called paranoid. Those who wait are called prudent. Until suddenly, the roles reverse. This is where the story closes. Not with a crash, but with a narrowing of options, a narrowing of access, a narrowing of who gets to participate on favorable terms. The market doesn't end. It stratifies. And once stratification sets in, movement becomes vertical, not horizontal. Up the chain for some, out of the chain for others. That's why this matters now, not later. Not when headlines catch up, not when price feels high enough to be interesting, not when everyone agrees on what's happening, because agreement is the signal that opportunity has already passed. This moment, the one that feels confusing, incomplete, unresolved, is the only moment that ever matters. After that, all that's left is adaptation. And adaptation is always more expensive than preparation. So if this reframed how you see silver, power, and markets, if it disrupted the comfortable story you were given and replaced it with one that actually explains behavior, then don't let it end here. Like the video, share it with someone who's still watching the price instead of the structure. And subscribe, because this story doesn't end with silver. Silver is just where the pattern became visible. What comes next follows the same logic. And by the time most people recognize it, the outcome will already be decided.